Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tshepho Modiba, and thanks for joining me. Tonight, I'm joined by Dexter Mahachi, research analyst at Momentum SP Reid Securities, for a look at East African cement makers who face a significant drop in revenues due to cheap imports and rival foreign firms. Dexter, thank you for joining us, as always.
Always a pleasure.
Let's broadly speak cement on the continent, and then hone into East Africa, and then hopefully touch on one or two players there. Your thoughts about where we stand currently?
I think because of Africa's infrastructure deficit, the cement sector is one of those sectors which is basically still got a bit of a run to go.
Right.
Quite a lot of countries need to put up roads, need to put up buildings, need to put up dams and stuff. So you find that cement demand as a whole, if we look over the next decade or so, I'm not expecting it to tailor off at all.
And what are the benefits that, I guess, local producers or producers who are domiciled on the continent have over and above our foreign peers?
I think one of the big key advantages, of course, is the fact that cement is a bulky product.
Right.
So if you're inland in most African countries, if you're a cement producer which is domestic, let's say you're in Zambia, you'll tend to have a greater chance of being more market dominant than somebody who tries to import cement and bring it into the country. And also you have to contend with the tariff structures of the various countries as well.
Right. Okay. Let's hone in East Africa. Yeah. What's the current lay of the land there?
Basically, East Africa, as you know, is one of the fastest growing regions in Africa at the moment.
Right.
Average growth in the whole area is average GDP growth is about 6 to 7%. And what this has meant is that you find a lot of governments have been putting money and concentrate and actually borrowing money from China and a few other sources just to put it into infrastructure. Right. In Ethiopia, for instance, they're expecting to put, they're basically putting money into big projects like a $4 billion US dollar dam that they're building. Whilst in Kenya, there's big infrastructure projects as well, like the standard gauge railway they're trying to build, which will link Mombasa with Uganda and Rwanda as well. Right. And that's going to be roughly about $13 billion US dollars or so. Right. So there's quite a lot of money being flowing into infrastructure in East Africa, into roads, into ports. And also you have a situation whereby consumer demand is resulting in the construction of shopping centers, because a lot of consumers are suddenly wanting to buy the latest Gucci, the latest Prada apparel, because of the fact that the East African consumer suddenly has a bit of money to spend, and that has stimulated demand for retail shopping centers, and of course more roads and more infrastructure as well along those lines.
This sounds quite positive for the sector.
It is quite positive. I think it's a good indicator for growth in that area. If you look at it, consumption for cement alone in Kenya over the past 3 years, it has grown by something about 13-14% or so per annum on average. Right. And it's the same with Uganda as well.
Right. Now let's drill down to, I guess, then the producers. Have they been able to take advantage of this theme? Will they be able to take advantage of it going forward?
I think yes. It's been a boon to a lot of countries, a lot of companies, particularly Bamburi Cement. Right. Bamburi Cement is Lafarge's subsidiary, yep. And it's been it basically controls most of the cement production in Kenya and in Uganda as well through its subsidiary called Hema Cement. They have a 60% market share in Kenya, right. And we've seen they basically had very decent profit increases over the past 2 to 3 years. However, recently profits have sort of slowed down because of increased competition. And we'll find that revenues were down about 1% at the half year, profit before tax was basically down about 5%
Now
year on year.
that revenue profile, is that a function of losing market share?
It's a function of the fact that they had to basically reduce prices
Right.
in order to maintain market share.
Gotcha.
So revenues had to go down.
Gotcha.
Yeah.
And naturally that impacted margins as well.
Exactly. Margins were down, profits were down, about 5% or so.
Okay. Before we move on to one of my favorite businesses,
Sure.
Dangote Cement, certainly from a margin perspective, what do East African margins or Bamburi's margins look like in comparison to Lafarge in Nigeria, as an example?
I think really the margins in East Africa are a lot thinner than the margins that you get in Nigeria.
Right.
Because what you find in East Africa, you don't get the tax breaks that you do in Nigeria. Nigerian government had a specific program to try and reduce the taxes if you are expanding capacity.
Right.
And you'll find that you pay next to nothing in terms of your profits after tax.
Right.
In terms of the taxes in Nigeria, whereas over in Kenya and the East African countries, we're talking we're talking taxes around 30%,
Right.
between 25 to 30%. So you find net profit margins of around between 11 and 15%. Whereas if you compare in Nigeria, you get net profits sometimes with the likes of Dangote around 30 to 40%.
Right. I mean, 11 to 15%, that's pretty decent margins in the cement space.
It is pretty decent margin, but my expectations are that is going to be a lot thinner going forward.
Right. With increased competition.
With increased competition. Plus you find that the Kenyan government, Kenya is basically the largest consumer of cement in the region.
Right.
And the Kenyan government have basically agreed to reduce the tariffs on imported cement from 35% to 25%.
Right.
So that's going to result in increased competition there.
So what does that mean for the outlook for Bamburi in particular? I mean, they're the dominant player there. Does that mean they're likely to see their market share decrease, but revenue growth in general?
Look, revenue growth is not going to be as good as it was previously. They're going to be lucky if they make revenue growth of 5% going forward.
Really?
Yes,
Okay.
because what you find also is that there have been other players like Dangote,
Right.
which have been building plants. There's also an Indian manufacturer as well, which is building plants in East Africa, and basically the supply of cement is going to rise. Dangote is putting up a 1.5 million metric ton, and another 3 million metric ton over in Tanzania as well.
Right.
And then you get other players like ARM, which have also been expanding capacity.
Right. So the future doesn't look so bright for Bamburi.
Look, the bright part of this is the fact that the cement demand is not tailoring off.
Right.
It remains high. However, what we're seeing going forward is they're going to be winners and losers. There are guys who are going to lose market share and guys who, due to there being new entrants, and also they're going to be guys who are basically going to either maintain market share or grow a little bit.
Right.
I'm looking at Bamburi being one of those which is able to maintain part of its market share.
Right.
But ultimately, we'll find the new players like Dangote, which might have more efficient plant, will be a lot more profitable than them.
Okay, so let's focus on Dangote.
Yes.
What is the outlook like from a revenue perspective for their business? What are they doing right in East Africa?
I think really one of the key issues is that they've been able to get to base their factories close to where they get the materials from.
Right.
So that has been just getting concessions for limestone and so forth is a key metric for a lot of the players. But one of the biggest problems you'll have in East Africa is the fact that the power is not cheap, and power consumes almost 40% of basically your cost of sales and cost of production.
Right.
So that is one of the key downside risks, that the fact that power will be hard to obtain in East Africa.
Right.
However, a positive about Dangote is that they have very efficient plants. They have some of the newest plants available.
Right.
And if you recall, about a year or two ago, they signed a big deal with a Chinese company, which is going to be basically installing some of these new plants using new production techniques. Right. Across Africa. So in my view, that alone, the efficiency gain that they'll get from there will enable them to make decent margins, particularly if we look at the fact that we're not expecting the Kenyan government and the Ugandan government and the Tanzanian government to slow down in terms of their infrastructure spend.
So the more efficient plants, does that mean that they have structurally higher margins?
That is true. They will basically have structurally higher margins because what you tend to get is whenever and what that will ultimately mean is that the cost price per bag of per 50 kg bag of cement will be a lot lower for them. So they're not going to suffer as much as when as much as the other producers in terms of if the price of cement was to fall because of increased supply in the region.
From a market share and revenue growth perspective, what does their outlook look like?
Dangote in Kenya alone, judging from what they've done previously in markets like South Africa and Zambia and so forth, I should think that within the first year of operation, at least, they should manage to get about 15 to 30% market share. Right. Once they're able to enter, because one of the things that they do is to actually collapse the price. Right. Of cement. So there's going to be some interesting days in the next few years for cement producers in East Africa.
Perfect. Let's leave it there. Thanks to my guest, Dexter Mahachi. See you again next week. Thanks.